Welcome to Capital Grounds Podcast. I am Joe Fisher, got my partner Nick Miller here. We are a part of SITG Capital, and we're bringing you a podcast today to talk about really just general idea of kind of what we're doing in the real estate markets and the private markets, and how we can maybe impart some wisdom upon you. Nick, why don't you introduce yourselves to the audience here?
Yeah, so thanks, Joe. I appreciate that. Again, my name's Nick Miller. I'm from Kansas, born and raised, and went to the University of Kansas, have a degree in finance. That was a number of years ago. I've been in financial services for over a decade, and historically, I've got my Series 7, my Series 66, and I've been on the advice side of financial services for a number of years, but have recently joined Joe here at SITG Capital, and we're looking to spread the word about what we do, what we have to offer, and today anyway, just have a nice conversation about real estate and what the current market looks like.
Yeah. I mean, we really wanted this to be a little more informal, a little more fun. We can talk about details like a pro forma and things like that, and we're going to have that educational type stuff on our website. But for us, this is kind of more of a conversation. Like Nick, I started in the financial industry about a decade ago, had my Series 7, 66, a few other things that go along with that industry, right? So I worked in that industry for a long time, and then I've been working in real estate since 2017. I started a home flipping business, and eventually 2019 met my partners at SITG Capital. We were just investing our own money, trying to do better than what we could do in the stock market. And we found out that, we can really open up some great opportunities to some other clients. And so that's kind of how we got started with SITG. We're, trying to do things a little bit differently here. So I'm gonna have Nick kick us off on, it's called Capital Grounds for two reasons. So we're talking about capital, and then we're talking about grounds, quite literally grounds in two different sense, right? So we're talking about grounds from the sense of it, being a play on words for real estate, and grounds because coffee. We're talking about our coffee grounds here in the morning and what we're drinking, and what mug we have, and kind of how that relates to our personal life. So I'll let Nick go ahead. Tell me what you got in the cup there, Nick.
Yeah, thanks, Joe. Thanks. So I'll tell you, this is you probably can't see it here. It's Yellowstone. It says
I can see it
along the bottom here. Okay,
Ooh,
great. Yeah, so this morning I've got Candlelight Blend from J&S Coffee, a small coffee shop. They roast their own beans, grind their own beans in-house here in Lawrence, Kansas. So their Candlelight Blend's nice. It's a good medium roast. But I'll tell you a quick little story about this mug. About almost the same mug when my wife and I went to Yellowstone and we were first dating. And it was my favorite mug at the time. I loved the shape of it. I liked the kind of pot belly shape, and took it to work with me when I was at Charles Schwab. I drank from it every day happily, and one morning knocked it off my desk and it shattered. So I decided to start looking for another mug identical to that one. Searched eBay. It's been 5 years, and it just showed up, popped up on eBay a couple of weeks ago. So I bought it, and I think the story's even better now. So
the story is better. Wow. Yeah. Waited 5 years for that. That's pretty good. That's pretty good. Well,
yeah,
cheers to that,
yeah, cheers to that for sure. Cheers. So, yeah, I appreciate that. But, so Joe, let's dig in a little bit here. This is our first episode. There are a lot of people that may not be familiar with our firm. Why don't we talk about a little bit, let's talk about what SITG stands for, what it means, and what it means to us and the firm.
Sure. Yeah. So, when we first talked about what the name was going to be and what it was going to stand for, We came up with SITG because it stands for skin in the game. And yeah, it might be a little cheesy and all of that, but there's an underlying principle that really, makes sense there, right? So we invest in every single project we do. Every single project we bring to investors, we're putting our own money in there. We found when working in the financial industry, we found a couple of things. And, Nick, if you have any additional information you want to provide on this, feel free to. But the fund managers that
Sure.
invest in their own funds tend to outperform the fund managers that don't. So, there's a couple things there. We want to be aligned with our investors, and we want the biggest portion of our returns to come from making good investments, not from charging investors any type of fees to sell or buy or anything like that. There's a lot of syndicators out there, and it's gotten more popular in the last few years, but there's not a lot of people that don't charge those type of fees. We're really trying to differentiate ourselves in that category and make sure that we're wholly aligned with every single investor that wants to invest with us.
Absolutely. And Joe, one of the reasons you and I became friends in the first place way back when in the banking world is because we both wanted to be and acted as advocates for our clients and our customers. And I think, I probably, coming onto a firm who believes in the same principles that I do as an individual is powerful. It's really powerful. And I think it speaks to the kind of firm that we are, that we're willing to put our money where our mouths are,
Right.
We're not here to just make a buck. We're here to build wealth. Yeah. With our clients. We're on the same side of the table.
Yeah. Yeah. Whether you like, what's his name, Ken Fisher or not, he's got a good, saying in their commercials, in Fisher Investments commercials. He says, "We do better when our clients do better." And man, if he didn't take that, we'd say the same thing. So that's how we feel. That's how we want to move things forward. We want to make sure we're winning, but if we're winning, you're winning. That's ultimately what it is. So that's our investment philosophy. We do a lot to get you there. And like I said, our due diligence process, I feel, is one of the best because we are investing our own money, and our capital's on the line every time we go into a project.
Absolutely. And when we're doing our due diligence and we're crunching the numbers, we put some cushion into those because we want to make sure that in worst case scenario we're still in good shape. And often that can mean if a deal is already tight on the numbers, once we build in the cushion, that might break the deal. But the market that we're in right now, there's a lot of opportunity out there, and I think it's only going to get better.
Yeah. So that brings me to a segment that we're going to start doing, and there's not a ton of news out there as far as we're going to call state of the grounds. So, state of what's going on in the real estate market. But state of the grounds, Nick and I kind of just pulled CBRE's 2023 market outlook just to kind of go over what people, what the experts are saying. If you're not familiar with CBRE, Fortune 500 company, based where I am, which is in Dallas, Texas, and they've got their hands in all parts of the real estate market. So they do some great research analysis, and we do use that from time to time just to look at overall trends. But basically, what they're saying is they still see not quite as strong as we have seen, obviously, but they still see a strong multifamily market for 2023. They're saying they can see will likely increase a little bit, but supply ultimately is not catching up with demand. I think in that article, and we'll post the article for you guys to go read. It's a pretty short read. I think they're basically saying 3.5 million short by 2035 as far as new apartments, houses, etc. So we're still at quite a deficit, and particularly markets where we invest are at even more of a deficit. Um, Dallas, Houston, all these Texas cities that we got our start in and that we're heavily invested in, they are all experiencing major job growth and not major. I mean, major construction, yes, but it doesn't catch up. So I think I told you, Nick, there was a article in the Dallas Business Journal a couple weeks back. They did analysis last year. Dallas added 255,000, somewhere around their jobs, and there was only about 50,000 new residences that came to market. So 50,000 seems like a lot, but for every 2 jobs, you should have 1 new residence because your people are moving for those jobs, et cetera. And so that would put you at, about 100,000 short. And it's been like that for years. So it really hasn't caught up. We're not afraid of an oversupply situation like 2008 or 2009.
Yeah, certainly, certainly. And, I think, in some of the reading that we've been doing recently, the cost of owning a home, especially with the COVID, I don't know, fire sale that we saw in a lot of homes and driving
Yeah,
prices going up, the cost of owning a home is so much greater now than it is to rent. With
absolutely.
the still lack of supply available, demand might be receding a little bit in the housing market, but the rental market remains strong. And,
Yeah.
the data suggests, as you and I talk about all the time, the data suggests that we're becoming a nation of renters, whether or not you
Yep.
like that. It's a problem that remains. A housing problem is not something we need right now in our society. So the more that we can
Hmm.
do, the better.
Right. Yeah. Yeah. No, I'm glad you brought that up, Nick, because in that CBRE article, it does go over that as well. The cost of home ownership versus rent, and the cost of home ownership spiked with rates, as you guys can probably guess. And so rent is now significantly cheaper. And I think in there they said, I mean, we could, we'll share that article with you guys, but you can see that it's a huge change in the gap, like the biggest in I don't know how many years, but it's been a long time since it's been that drastic of a change. So 100%, that's a good thing to note, Nick.
Absolutely. And as rates go up, we're seeing a slight curve in demand across the country in housing demand. But, the important thing is the areas that we're looking to invest in, and certainly in a lot of the major cities, demand remains strong,
Yep.
especially
Yep.
for some of our properties, the particular level at which we either offer rent or have homes for sale, those particular price points remain in high demand. And I don't see that changing in the near future.
No, and I mean, we think rates will eventually have to come back down again at some point, right? I mean, that's likely, but when, we don't know, and that's always the question is timing. I mean, with any type of investment, it's a lot of it's timing, and you don't know some of the variables that go into that.
Yeah, absolutely. Absolutely. And I mean, how often do we see, turmoil in the markets and then whatever the market might be, right? Whether it's the
Right.
stock market or the housing market, then you've got 6 to 9 months where things normalize. Maybe the environment remains the same, but the
Hmm.
news cycle
Hmm.
changes and things normalize a bit, and then demand can pick right back up. Um,
Yeah.
and we've certainly seen, Joe, I think maybe this is a good time to talk about price dislocation. And,
Sure.
let's talk about how the real estate market differs from the stock market, and in
Yeah.
particular, the areas in which we're investing.
Yeah. So, I mean, when we and I want to, in fact, I think what I'd like to do is probably do even a whole episode over price dislocation and what we're seeing right now in a few markets, and bring on a guest to talk us through that, right? Because that's a really big topic, and I'm glad you brought that up. I think for us, if we're
Yeah,
looking at,
that's a great idea.
the overall, just look at the private real estate markets and why we still feel there's tons of opportunity there, and will be going forward. Um, I don't know how many people listening are familiar with something called alpha. So I'll tell you what the Investopedia definition is. I got it written down here. So Investopedia says alpha is a term used in investing to describe an investment strategy's ability to beat the market or its edge. Alpha is thus often referred to as excess return, abnormal rate of return, which refers to the idea that markets are efficient. That's a key word. And so there is no way to systematically earn returns that exceed the broad market as a whole. So when we talk about public markets, I mean, Nick, you and I have seen this for a decade in the public markets. That is absolutely true. Extremely difficult for you to get an edge buying Apple, buying the S&P 500. You're going to go as the market goes. You really don't have any control over that, right? So if we're going to call alpha your edge, just for simplification purposes, right? It's difficult to find one in the public markets. That's why you have a different fund manager, outperform the other ones every single year. It's very, very rare that they're back-to-back outperformers, right? I mean, we saw that every single time we looked at the market. Real estate's a little bit different because we have a lot more control over the inputs, and we can go out and find an edge in an individual property, right? It's a lot more controllable on a small, and I'm going to talk about scale as far as like how that pertains to benefiting us on a larger scale too. But you can look at it even from, a small single family home. If you spent enough time going out into the market looking for a small single family home, you could find a good deal. Right now, you could find a good deal. And you might want to flip it. You might want to rent it. You'd probably do an analysis on that, and you would find something that you could get below market value, below the averages. So we're looking at that from a bigger perspective, from a scale perspective. We want to go to some of the distressed apartment complexes, maybe 400 units. In some cases, we're looking at more. Somebody may have bought last year at the peak. Nick and I are looking at a deal. I'm not going to give you the name because it's an active deal, but last year they bought for around $100 million. And this year it looks like they'll probably be willing to offload it for around $60 million, somewhere in there, right? Give or take a few million on either side of that. But wow, I mean, that really illustrates what you can find.
Huge opportunity.
Yeah, exactly. And we know we can go in there, and we know we can, update the apartments. We know generally what that's going to cost. We know at scale doing that with our team that we're going to do it for cheaper than, what just Nick and I could do by ourselves, or what, an IT professional can do if they had the money to go buy it. Because we've been doing it with our partners for so long, we have, we can go buy paint for 30% off or whatever it is. And you add all of those things up and you have a significant edge over just what you can do in the general market.
Absolutely. And when you look at rates these days, we've got, what we call the risk-free rate, what you can get in a treasury or a CD or something ultra conservative. When you're looking at 4.5%, 5% on some of those, some of those yields, it's a much more competitive place out there if you want to produce reasonable returns, at least on the stock market side, because you have so little control, like we discussed earlier, without taking incredible risk. The beauty of the real estate market is a number of the things that you've mentioned already, but also, we've got a particular market that's not necessarily directly correlated with the stock market, right? And then if you look on an even smaller scale, regionally, there can be even more of a buffer there, and certainly risks in and of itself, but there's a lot of great opportunity to add value and be compensated for that.
Yeah. Look, I mean, I think and Nick, you chime in on this too, but for me, I've always been a big proponent for my clients of diversification, specifically because of reasons like last year, market's down over 20%. Real estate market, if you were invested in multifamily and you were invested with the right people, that's key, right? Not somebody who's selling $100 million place for 60 this year. You are, you're outperforming the stock market. So for me to have a piece of that in the private real estate markets makes sense. Now, as far as what your specific percentage is, it kind of depends on you and your risk tolerance, right? But generally speaking, I think to have 10, 20 or so percent of your portfolio in private markets, I think makes sense for a lot of people. Because if you do look at the overall returns versus the stock market, multifamily, and then I believe, or maybe it's industrial multifamily, I don't remember which is first, but those two are the highest. Multifamily has the best risk-adjusted return. So it's almost like your risk for that, which again, risk is really important in these things, right? Your risk is about what it is for a treasury, right? But your return is a percent or two higher than the stock market. So, I mean, that is just fantastic. And that's over the last 20 years. So it's really hard to beat that. And that's why I think it's important to have a piece, I'm not saying all of it, because again, big diversification proponents in these types of markets.
Yeah, I agree with you. And I think you made a good point. Risk is an important consideration. We can talk about the beauty and the potential return and multifamily. In the same breath, we talk about a firm that bought a property and are selling it at a 40% discount almost this year, a year and a half down the road. So there are a number of variables in a deal and in a project, but the great thing about real estate in general is that you have more control over those variables than you do with the stock market. You can't walk into the boardroom at Apple or at Google or Microsoft or whomever the cherry pick of the week is.
Right.
You can't tell them how to do their job and expect to change. Number one, you can't tell them how to do their job at all. But number two,
Sure, I don't think Tim's going to like it if you call him up, right?
I would agree. But certainly, not something you can see change in within a year, 2 years, right? Whereas real estate, you can go in and in a matter of months, you can add value. You can have a positive scenario.
Yeah, you're right. And I mean, one thing that helps me from a risk perspective, it's a physical asset. If I've got questions about it, I can drive over there. I can look at it. I can see how it's doing. I can ask people who live there, hey, do you like living here? What's going on? What do you think? So, I mean, it's, to me, there's a reason that I've invested more and more of my net worth in real estate since I started investing in it, and looked at the stock market as just a piece of what I'm doing and not the entirety like I used to.
Absolutely. I agree with you. It looks like, looking here at the time, we've got less than 3.5 minutes left. So maybe this is a good opportunity for us to wrap up, our conversation for today. But certainly we've got a lot of topics we can touch on next time. And,
absolutely.
I want to remind listeners, viewers, if you haven't checked out our website, check it out. SITG, remember, skin in the game, SITGcapital.com. You can email me, nick.miller@sitgcapital.com, or Joe. Joe, you can give your email if you'd like. And we'll include links in the information below to, some of the items we've mentioned, and certainly to our website.
Yeah, we'll put all that in there for you guys. And, let us know if you've got a deal you're wondering about. We'll look at it for you. I mean, we enjoy this stuff on a day-to-day basis. And as investors, there's a few things you want to look out for. I think you want to look for track records. I do think it's really important that, they're investing something alongside you. Look for those who are not reliant upon acquisition and disposition fees, buying and selling fees. You've got somebody, Grant Cardone, great marketer, but he makes the majority of his money when he buys something and then when he sells something. There's not much of an incentive for him to buy an investment at a lower price, because that means he's actually taking a lower fee, right? So just look for things like that, and we're going to continue to put education out there for you guys, and send us your questions. This is our first one, so going forward, we're going to try to answer a couple of questions every episode. So yeah, email us whatever you got.
Certainly. And I want to clarify, we find a lot of value in brokers, but make sure that you're working with a broker and not somebody who's positioned themselves as a broker, but calling themselves, an investor of some sort, right? That's the
Right.
key. That's the key. You want to make sure they're on the same side of the table with you. But yeah, check us out, send us emails. Would certainly love to hear stories, feedback, comments, questions, anything you've got, send it our way.
Yeah. Well, thanks, Nick. Appreciate the time, man.
Yeah, thanks, Joe. Likewise. Enjoy the coffee. We'll see you next week.
You too. Cheers.